Did you know that a single financial decision, like delaying your retirement by 1 year, can increase your lifetime savings by over $100,000? Every day, we make choices about saving, spending, and investing, but most of us never see the powerful systems running in the background. From the interest on your mortgage to the performance of your pension plan, our financial lives are influenced by complex tools designed to manage risk in an uncertain world. But what if you could understand the logic behind those tools, and make smarter decisions because of it? According to finance experts and economists, the backbone of modern finance isn't luck, it's math. These aren't just static equations, they're dynamic models that adapt in real time to market changes, consumer behavior, and global risks. As Nobel laureate Robert Merton once said, financial models allow us to turn uncertainty into structure. These models, particularly continuous time models, govern everything from your 401k strategy to how corporations manage multi-billion-dollar portfolios. Understanding these financial modeling systems isn't just for Wall Street, it empowers everyone. Imagine navigating a highway blindfolded. That's what managing money without understanding risk models can feel like. Now imagine having a GPS that updates your route instantly based on traffic. That's what these continuous time models do. They simulate countless what-ifs in real time, helping individuals and institutions make sound decisions even when markets shift unexpectedly. Whether you're buying insurance, investing in stocks, or funding a business, these models are silently shaping outcomes, an essential foundation for smart personal finance decisions. So, ask yourself, do I truly understand what's driving my financial choices? What if every major investment, retirement fund, or insurance product you interact with was built on assumptions you've never considered? These models reflect real-world priorities, like risk tolerance, time horizons, and market volatility, but without financial literacy, we're passengers on a journey we don't control. Shouldn't you know the map behind your money? If you're ready to move from uncertainty to confidence, start by learning the mechanics behind your money. Explore how financial models work, why they matter, and how they inform everything from public policy to personal budgeting. Like, share, and subscribe for more insights into how finance, risk, and mathematics intersect to shape your future. Because as the saying goes, you can't control the wind, but you can adjust your sails. Understanding the math behind your money is the first step in learning how to steer. About the author. Robert C. Merton is a Nobel Prize-winning economist and renowned professor celebrated for his groundbreaking work in financial economics. He played a pivotal role in developing continuous time models and advancing option pricing theory, transforming modern finance. Merton is also the co-author of several foundational texts, including the influential theory of rational option pricing, cementing his legacy as a key architect of contemporary financial thought. Key Takeaway 1. How continuous time models power the financial world in real time. Imagine a world where every financial decision, from buying a house to trading stocks, unfolds in a market that never sleeps. Prices rise and fall by the second. Risk is a constant companion. And decisions must evolve as quickly as the data behind them. In this unpredictable landscape, traditional tools fall short. That's where continuous time models come in. Powerful systems that track and optimize financial behavior as it happens, not in snapshots, but in real time. They offer clarity in chaos, precision in a world defined by uncertainty. As Nobel Prize-winning economist Robert C. Merton once said, "It's not the model that's uncertain, it's the world." Merton's pioneering work laid the foundation for using mathematics to understand how financial decisions unfold over time. These models rely on stochastic calculus, a mathematical framework built to handle randomness with grace. They provide insight into two essential questions in finance: how should we allocate resources over time? And how do we adapt in the face of uncertainty? For professionals navigating dynamic markets, understanding continuous time finance is no longer optional, it's essential. To visualize the concept, think of budgeting as a still photograph versus a live stream. Traditional methods offer a snapshot of your financial position at one point in time. But life, and the market, don't work that way. Continuous time models function like a real-time video feed, constantly updating your financial map as prices shift, risks emerge, and opportunities arise. Whether you're a household planning for retirement or a company evaluating an investment, these models help optimize decisions in a fluctuating environment. So, how do markets actually absorb all this complexity? Through capital markets, the trading grounds for stocks, bonds, and other securities. These platforms allow investors and businesses to exchange risk and reward efficiently. Continuous time financial models accurately depict how these interactions create prices, manage risk, and determine value. Institutions use them to hedge volatility, price insurance contracts, or design smarter investment strategies. Without them, the financial system would be like a ship navigating stormy waters without radar. Understanding these models isn't just about complex math, it's about seeing the world more clearly. It's about making smarter decisions today while preparing for the uncertainties of tomorrow. So ask yourself, are you relying on outdated snapshots to guide your financial life? Or are you ready to explore the models that mirror reality as it happens? Because the future of money moves fast, and you deserve to move with it. Key takeaway 2. How math can predict your financial future, even in uncertain times. What if you could map out your financial future, even with all of life's unpredictable twists and turns? From market crashes to medical emergencies, planning how much to spend now versus how much to save later can feel like trying to forecast the weather a decade in advance. But Continuous Time Finance offers a groundbreaking solution, a mathematical framework designed to help you make the smartest financial choices in an uncertain world, moment by moment. At the center of this framework is a powerful idea known as the lifetime consumption and portfolio selection problem. Simply put, it's the question, how do you divide your money between spending today and investing for tomorrow? To answer this, economists use utility functions, mathematical models that capture our preferences, behaviors, and risk tolerance over time. One popular approach, constant relative risk aversion, helps explain how people adjust their financial decisions as their wealth changes, providing insight into why we spend or save the way we do. Think of it like planning a road trip with constantly changing weather, gas prices, and detours. You need a model that not only maps the journey but adapts with every mile. Stochastic dynamic programming, a key tool in continuous time finance, does just that. It breaks down complex financial decisions into manageable steps, ensuring that every dollar spent or invested fits within a broader plan, governed by the budget equation, which tracks your financial boundaries in real time. But how do these models hold up in the real world? Surprisingly well. They align with the life cycle hypothesis, a widely accepted economic theory that says people aim to smooth their spending throughout life. These models show how consumption changes from your working years to retirement, and how your age, income, and even lifespan uncertainty affect those choices. They go beyond theory to guide practical strategies for everything from retirement planning to wealth management under uncertainty. So here's the big question, are you planning your future based on guesses or guided by insight? With the power of continuous time finance, you don't just react to financial change, you're prepared for it. Like, share, and subscribe if you're ready to discover how mathematics can improve lifetime financial decisions, provide smart portfolio strategies, and help you plan with clarity, even when the future is uncertain. Because as the saying goes, it's not about predicting the future, it's about preparing wisely for it. Key takeaway 3. How options pricing models change the financial world forever. What if you could predict the price of a contract tied to a future event, with near mathematical precision? In today's fast-paced markets, options and warrants are not just tools, they're essential strategies used to manage risk, reward, and everything in between. But behind these financial instruments lies a quiet revolution, the rise of continuous time models, which gave traders a reliable way to price uncertainty in real time. Without them, modern markets would be chaotic and unstable. At their core, options and warrants derive their value from something else, typically a stock. An option gives the right, but not the obligation, to buy or sell that stock at a set price, within a specific time. Warrants work similarly but are usually issued by companies and have longer durations. The secret to fair pricing lies in arbitrage-free pricing, a principle that prevents market imbalances by ensuring no trader can make riskless profits from price differences. It's not just theory, it's the guardrail that keeps financial markets from unraveling. The game changer? The legendary Black-Scholes model, which introduced a revolutionary way to value European-style options. It assumes constant trading, no transaction costs, and creates a replicating portfolio, a mix of the underlying asset and a risk-free investment that mimics the option's payoff. By adjusting this mix continuously, the model produces a fair market price. This innovation didn't just stay in textbooks, it became the foundation of the modern options pricing industry, offering unmatched precision for traders and institutions alike. But real markets are messy. What happens when stock prices don't move smoothly? Or when options have unusual terms? That's where advanced continuous time models step in. They adapt the original framework to handle sudden jumps in prices and exotic contracts with complex structures. From weather derivatives to employee stock options, these extensions make it possible to price and manage financial uncertainty in almost any scenario. So here's the question: are you blindly betting on market moves, or using the math that guides billions of dollars every day? These models are not just academic tools, they power everything from corporate investment decisions to global derivatives trading. If you're ready to dive deeper into the tools that make the financial world run, because understanding how options pricing works, mastering arbitrage-free valuation, and leveraging continuous time financial models could change the way you see money forever. Key takeaway 4. How option theory is revolutionizing corporate finance. What if a company's value didn't change, no matter how it's financed? That's exactly what the groundbreaking Modigliani-Miller theorem claims. In a frictionless world, it doesn't matter whether a firm uses debt or equity, its value stays the same. While real-world factors like taxes, bankruptcy costs, and market frictions complicate this idea, the theorem laid the cornerstone for a deeper exploration of capital structure. And from that foundation emerged one of the most powerful tools in corporate finance: contingent claims analysis, CCA. Imagine looking at a company not as a static balance sheet, but as a dynamic portfolio of embedded options. That's the essence of CCA. It applies the same math used in options pricing to corporate securities, allowing analysts to break down debt and equity into precise, quantifiable components. For example, corporate debt can be seen as risk-free debt plus a put option held by equity investors. This view transforms how we evaluate a firm's value under uncertainty, and it's backed by rigorous, real-time mathematical modeling. To make these valuations even sharper, CCA integrates dynamic portfolio theory, optimizing how firms manage assets and liabilities over time. Securities are treated as contingent claims, their worth tied to underlying factors like stock price or market volatility. This flexible framework is invaluable in real scenarios, pricing risky corporate bonds, estimating the probability of default, or understanding how changes in capital structure impact firm value. It's a next-level approach to financial strategy. But this isn't just theoretical, it's reshaping corporate decision-making. Companies use CCA to assess the cost of debt, strategize on capital issuance, and even prepare for restructuring or bankruptcy. Investors, too, benefit from clearer insight into risk and return when allocating funds. Whether it's calculating how assets are divided during financial distress or estimating shareholder outcomes, CCA makes complex events transparent and actionable. So, here's the question: are you relying on outdated metrics, or embracing tools that see through financial uncertainty with precision? With contingent claims analysis, firms and investors gain a more accurate, flexible way to assess value. Because in today's market, insight is your greatest asset. Key takeaway 5. How InnerTemporal models predict risk, returns and economic change. What if your investment returns depended not just on market moves, but on how the entire economy shifts over time? In today's rapidly evolving financial landscape, prices don't just reflect risk, they reflect how that risk changes across time. Enter the InnerTemporal Capital Asset Pricing Model, ICAP, a cutting-edge framework that doesn't just account for a single moment in the market, but tracks how risk and reward evolve over a lifetime of investing. For anyone serious about strategy, this model offers clarity and complexity. The ICAP is an evolution of the classic capital asset pricing model, CAPM, which links expected returns to market risk. But ICAP takes it further by introducing the security market hyperplane, a multidimensional lens showing how a variety of risks, from interest rate changes to economic shifts, influence asset prices. As economist Robert Merton helped establish, understanding dynamic risk is essential to understanding value. With ICAP, finance moves from a one-note melody to a rich symphony of variables. To make these complex ideas more accessible, the consumption-based capital asset pricing model, introduced by economist Douglas Spreeden, ties everything back to something deeply human: our consumption choices. If investors value consumption today more than tomorrow, it shifts how assets are priced. Imagine the market as a mirror of our collective financial fears, needs, and desires. CAPM captures that reflection with precision. It links financial theory directly to real-world economic behavior. So how does this help you, the investor or policymaker? These models offer practical tools for portfolio optimization. For example, by identifying assets that perform well under specific economic conditions, you can hedge against future downturns and position your capital where it will be most resilient. ICAPman can also help explain how markets reach equilibrium, a state where supply and demand for risk and return align. That insight isn't just academic, it's actionable. So here's a thought: are you making decisions based on past performance, or using tools built for the future? With InnerTemporal asset pricing models, you can make smarter, more informed choices that respond to a changing economic world. Are you ready to master the forces that shape risk, reward, and return? Because understanding ICAP, unlocking the value of CAPman portfolio management, and applying dynamic risk pricing might just be the smartest investment you make. Key Takeaway 6. How continuous time models are shaping the future of public finance. What if governments could forecast decades into the future, with mathematical precision, to protect your pension, stabilize banks, and plan national growth? In a world increasingly shaped by economic uncertainty, public finance stands at the forefront of crucial decisions about how we manage shared resources. And the key to navigating that uncertainty? Continuous time financial models, tools once reserved for Wall Street, are now transforming how policymakers plan for the long haul. These models go beyond traditional forecasting by factoring in the fluid, ever-changing nature of the economy. One powerful example is designing public pension systems. While adjusting for inflation helps, it's often not enough. Enter consumption-indexed benefits, a smarter strategy that ensures retirees can maintain their lifestyle relative to broader economic trends. Continuous time models allow governments to calculate optimal contribution and benefit structures, balancing today's budgets with tomorrow's promises. But pensions are just the beginning. Consider loan guarantees and deposit insurance, the quiet safety nets that stabilize entire economies. Take the FDIC, which insures U.S. bank deposits up to a limit. Pricing these guarantees is complex because they hinge on unpredictable events like bank defaults. Here's where option pricing theory, borrowed from markets, proves vital. By applying continuous time models, policymakers can estimate these costs even without market data, preserving public trust and economic stability. Beyond crisis protection, these models offer insight into long-term growth strategies. Want to forecast how a nation's economy might evolve over decades? Ignoring randomness in variables like technology or demographics leads to flawed predictions. But by embedding uncertainty into economic projections, continuous time finance helps governments make better infrastructure, healthcare, and climate-related decisions, ones that hold up under stress. So, let's pause and ask, are our public policies built on static predictions or dynamic, reality-based models? Continuous time finance gives policymakers the power to manage uncertainty, not just react to it. If you believe in smarter planning for a more secure future, keep listening. Because modern public finance, powered by a stochastic policy modeling, and grounded in continuous time economic forecasting, isn't just theory, it's shaping the systems that support us all. In Continuous Time Finance, Nobel Prize-winning economist Robert C. Merton offers a revolutionary lens through which to view modern finance, one that replaces rigid, snapshot thinking with fluid, real-time models. At its heart, this groundbreaking work explores how financial decisions unfold not in isolated moments but across a dynamic, ever-changing timeline. Merton's vision empowers us to make smarter, more adaptive financial choices by embracing complexity rather than avoiding it. The book opens by introducing the core philosophy of continuous time modeling, that financial behavior is best understood not in fixed intervals, but as it evolves over time. This approach allows for more accurate assessments of risk, pricing, and decision-making. From managing portfolios to planning consumption over a lifetime, Merton lays the mathematical foundation that now underpins much of modern finance. A key concept explored is the lifetime consumption and investment problem, where individuals must balance current needs with future goals under uncertainty. Merton explains how utility functions and stochastic programming help chart optimal paths forward, reminding us that true financial security lies in dynamic flexibility, not rigid budgeting. Another highlight is the Black-Scholes option pricing model, which Merton helped develop. This elegant solution transforms how we price financial derivatives like options and warrants, using continuous time logic to replicate payouts and ensure a fair valuation. It shows how applied mathematics can tame even the most volatile aspects of markets. The book then dives into corporate finance, introducing contingent claims analysis, a method of valuing corporate debt and equity through option-based models. This shift enables firms to better understand their financial obligations and craft more resilient capital structures, even in the face of uncertainty. Merton's insights also extend to public finance, offering tools for designing more robust pension systems, deposit insurance, and economic policy. With continuous time modeling, policymakers can incorporate randomness and systemic risk into their projections, ensuring smarter, more equitable decisions for future generations. By bridging theory and practice, Merton provides an invaluable framework that is both intellectually rigorous and deeply human. Whether you're a policymaker, investor, or individual planning your financial future, this book reveals that understanding uncertainty is not just possible, it's essential. If you found value in this summary, please like, share, and subscribe to help spread knowledge that empowers thoughtful financial decision-making. And if no one told you lately, remember this: you are loved, you are worthy, and you are spectacularly capable of extraordinary things.